The June 2026 CPI report didn't just cool inflation, it triggered a $1.3 trillion chip rally in a single day. Here's what happened. June CPI fell 0.4% month-over-month, bringing headline inflation down to 3.5%, the biggest drop since 2020. Core inflation cooled to 2.6%, while PCE inflation stayed at 3.3% year-over-year. Chip stocks surged as markets priced in a Fed pivot. The S&P 500 rose 0.6% on the CPI news, with semiconductors leading the charge. The semiconductor index jumped 1.8% in a single day, adding $1.3 trillion in market value. Traders at the New York Stock Exchange react to the CPI print. Why did this matter? Because inflation is the Fed's main lever, and a cooler reading changes the entire market calculus. The Fed has been stuck in a higher for longer cycle. A cooler CPI print changes that. Monthly core PCE inflation has averaged 0.34% for the first 5 months of 2026, below the 0.5% threshold that would normally trigger a rate cut. 10-year Treasury yields fell 8 basis points on the CPI news, reflecting reduced rate hike expectations. PIMCO notes that if core PCE continues at 0.2% per month, inflation could drop below the Fed's 2% target by late 2026. TSMC's new Central Asian fabs have cut its energy costs by 40%, giving it a competitive edge as AI demand soars. Chip demand is growing 25% year-over-year, but supply chain constraints are easing. AI data centers are driving demand for advanced chips. So what does this mean for your portfolio? 3 concrete steps you can take. 3 actions you can take right now. Keep your emergency fund in a high-yield savings account or T-bills. Consider a small allocation to chip ETFs if you're comfortable with volatility. Don't chase the rally. Diversification matters more than timing. A $10,000 investment in T-bills, earning 4.5% APY, would earn $450 in a year, outperforming many high-yield savings accounts. Chip ETFs like the VanEck Semiconductor ETF have returned 18% YTD, but they're also 40% more volatile than the S&P 500. A 40% allocation to chips would have boosted a $100,000 portfolio by $7,200 in 2026, but also increased drawdown risk. The best move is often the simplest. Stay diversified, keep an emergency fund, and let time compound your gains. A diversified portfolio holds multiple asset classes. Inflation is always and everywhere a monetary phenomenon, but the Fed's reaction function is what matters for markets. Not financial advice, for educational purposes only. The next inflation print could make or break this rally. Subscribe and follow the Phantom Equity for more.